There are a lot of hype stocks around hydrogen out there that don't earn money and are overvalued and thus provide significant risks to investors. Air products and chemicals is nothing like that. This dividend aristocrat already has a strong existing business with industrial gases, which earns them a steady income, while at the same time being the #1 hydrogen supply company in the world. But for the last 6 years they fought hard for this position, and it doesn't come without costs. There were huge investments necessary already, and this is only the beginning. So we want to ask ourselves, is Air Products a good investment? And in today's video I break it down. I look at the business models and the markets of Air Products, analyze their mode and look at their latest financial statements. I'll also check the valuation to see if now is a good time to buy. My name is Florian and I use my background as a physics engineer to provide a more scientifically inspired stock analysis on this channel. So let's start at the beginning and have a look at the fact sheets first. Air Products and Chemicals, or more commonly known as just Air Products, has the ticker symbol of APD and they are listed on the New York Stock Exchange. They are working in the material sector and were founded in 1940. They have around 22,000 employees and the headquarters sits in Allentown, Pennsylvania. The market cap sits at almost $60 billion at the moment. APD is a leading industrial gas company that operates more than 750 production facilities worldwide. They provide essential gases for over 170,000 customers in various industries like food, refining, manufacturing and medical. But not only are they providing the gases themselves, they also provide the equipment that is necessary for gas processing and separation, like cryogenic air separation units or equipment for liquefying gases. They are also the leader in LNG equipment and process technology, and recently the company is also aiming to be the leader in the hydrogen economy by developing production facilities, fueling infrastructure and even collaborating with governments to provide hydrogen as a clean energy source. The company wants to establish this clean hydrogen production as a second major pillar in their business in addition to their traditional industrial gas sales. And what is interesting about the industrial gas business is that these gases are often sold in large volumes and the company, similar to their main competitor Linde, provides on-site gas production for large industrial users. This also involves the installation and operation of gas production plants at their customer sites. And combined with their long-term contracts, this helps them to establish good relationships with their customers and provides a stable and recurring income. When we look at the global presence, they generate 45% of its sales in the United States and Canada, about 25% in Europe, another 25% in Asia, and the remaining 3% in Latin America. So we do have a concentration on North America here, but in general, the company is well diversified geographics-wise. The vast majority of the business is done with long-running on-site or pipeline contracts. 24% are done with HYCO facilities that produce huge amounts of hydrogen, carbon monoxide or both. Air separation units or ASUs even make up 1/4 of the total sales. The long-running contracts of 15 to 20 years produce a stable and predictable recurring revenue. Another 33% are still generated with bulk business, where they provide large quantities of gas but without any local facilities to their customers. The contract times in this case are still 3 to 5 years. And while this is way below the long contract times compared to their on-site projects, it is still very long when compared to contract times in other industries. The rest of their revenue is generated with short-term contracts in packaged gas and their equipment sector. The biggest market for Air Products is the energy market, which makes up 24% of their sales. Here, they provide hydrogen for the refining process for oil and gas and supply gases like LNG for direct power generation. Further 21% are generated in the chemical manufacturing market, where they support the production of chemicals like ammonia, methanol and so on. 17% of the sales is done in electronics manufacturing, where they provide high purity gases and chemicals mostly for the semiconductor manufacturing. For the metal industry, which makes up 14% of the sales, they provide oxygen, nitrogen for processes like cutting, welding, but also hydrogen for steel making. The last quarter of the sales is split between manufacturing, healthcare, food and environmental sectors. So overall, the company serves a diverse range of industries and applications. Just 2 weeks ago, on the 10th of July, the company announced, together with Honeywell, that they will sell all their LNG process technology and equipment business to them. Honeywell will pay around $1.8 billion, all in cash. This decision was done so that they can focus more on its two-pillar strategy that I just showed. Hence, they want to grow their core industrial gas business and their clean hydrogen business. And especially this hydrogen business is getting a lot of investments at the moment. The company has committed $15 billion globally to such energy transition projects, mostly for green hydrogen. Of course, such investments have quite an effect on their balance sheet and their cash flows, but we'll come to this later. First, let's look at two concrete examples of such projects. The first is NGHC, the Neom Green Hydrogen Company that was founded as a joint venture between Air Products, ACWA Power and Neom, who came together to build the world's largest green hydrogen plant in Saudi Arabia. This shall be operated entirely on wind and solar power and produce 600 tons of carbon-free green hydrogen per day and export it in the form of ammonia by the end of 2026. The construction is already well underway and Air Products has secured an exclusive 30-year contracts for all ammonia produced in this facility, as well as being the contractor and system integrator for the whole facility. With this, they hope to lower the price for green hydrogen and ammonia, making it a cost-effective alternative for transportation and industrial applications. The second and more recent agreement was signed between Air Products and Total Energies just a couple of weeks ago by the beginning of July. Here, APD agreed to supply 70,000 tons of green hydrogen per year to Total Energies to be used in their European refineries starting in 2030. While there are many other projects, I find that these two examples already illustrate the company's strategy in both supplying and producing green hydrogen. However, most of these projects are still in the very early stages, and the way APD typically reports their financials makes it difficult to pinpoint the exact figures for hydrogen alone. Based on what we saw, it seems that the company is still a few years away from achieving profitability in its hydrogen business, mainly due to the substantial investments they are currently making. But I believe that the company, in contrast to many of the hydrogen hype stocks, already has a functioning business and can benefit from synergies of it. We also know that the energy transition will need a lot of green hydrogen in the future. So let's check where the market is going from here. The global hydrogen market is expected to grow with a CAGR of almost 8% until 2030. And while this already doesn't sound too bad, it is the average growth for all types of hydrogen. But here we need to distinguish between three major types. The most common type at the moment is still grey hydrogen, which is generated from fossil fuels and the process releases carbon dioxide, which is not captured. Sometimes this is broken down in even more categories depending on the type of fossil fuels used, but let's keep it simple here. The second major type is blue hydrogen, which uses the same process as grey one, but the CO2 is captured and stored. This already makes it much more environmentally friendly. Some of Air Products' new developments are targeting to produce blue hydrogen, but most of them are actually aiming at producing green hydrogen, which is the third type. This is fully produced by using renewable energies and water and thus does not produce any CO2 itself. And in case of this green hydrogen, the market is even expected to grow with a CAGR of almost 40% until 2030. However, the company is still earning most of its money with their industrial gases. And this market is also expected to grow, but much slower with 5.7% CAGR until 2031. So Air Products is operating in growing markets and especially hydrogen could play a huge role for them if the company can pull off its transition. But how strong is their position in these markets even? Let's check their strategic position by looking at the Porter's 5 forces of the company. First of all, I would estimate the threat of new entrants as quite low. The industrial gases as well as the hydrogen business require substantial investments to build the production and the distribution facilities. APD's size and its technological know-how also provide a significant advantage that makes it quite hard for newer players to enter the space. The threat of substitutes I would also estimate is quite low. Industrial gases are critical for many industries like healthcare, manufacturing or electronics. And substitutes are often expensive and less efficient. And even in the case of switching products, APD can oftentimes provide these substitutes. The competitive rivalry, on the other hand, I would estimate as high to medium. Most of these gases are basically commodities, and besides maybe the purity, it can't be differentiated between different suppliers, which drives the competition. In the last few years, this market has also consolidated through mergers and acquisition. Hence, on a global scale, their main competitor is Linde, and both companies are fighting fiercely for market shares. The bargaining power of their customers I would also estimate as high to medium. Air Products often enters long-term contracts with their customers. But these customers are often large industrial companies with significant bargaining power. This is somewhat mitigated by the high switching costs. And for hydrogen in large quantities, the supply is still very limited, so APD could gain an edge here with their current investments. The bargaining power of their suppliers I would estimate as medium. Air Products usually sources the raw materials and equipments from a large array of different suppliers. This, combined with the long-term contracts they have, reduces the likelihood of price increases and somewhat buffers the volatility of raw material prices. So overall, I would say that they have quite a strong position in this mature industrial gas market, and their long contract times help to provide a secure and predictable income. With their new hydrogen strategy, I think that they might be able to increase their growth over the long term. But at the moment, they are still pouring in the money, while the benefits probably still have to wait a couple more years. So now that we understand their position, let's see how their performance and their financials look. In the last year, the performance was not too good. The stock dropped by a bit more than 13%. In the last 5 years, while still quite a bit below the S&P 500, the company could produce 27% returns to their shareholder. And over a time frame of 10 years, we still see an underperformance compared to the index. But here we also see that during most of this time, the company was actually ahead and did only drop over the last year. So this could indicate one of two things. Either the company has troubles, or now is a good time to buy. And to find out what is the case here, let's have a look at their finances. The revenue, while generally growing, is showing the cyclical ups and downs of this industry. This is not as visible in the net income, and the net income is also growing with a quicker pace as the revenue, and so does the EPS. The operating cash flow is also generally increasing, although it was almost flat in the last 3 years. Again, showing the cyclical nature. The free cash flow, on the other hand, has dropped off a cliff in the last 2 years and is currently even negative. And when we look at their balance sheet, we find the reason why. This is mostly due to the increased capex spending that has grown rapidly during the last 2 years, mostly from all the investments in their hydrogen facilities and equipment. When we plot the operating cash flow, here in pink, against the capex in blue, we can see that the resulting free cash flow in orange is generally following the capex. So we can assume that the free cash flow can recover as soon as their investments are going down. So when we sum this up, we see that all the metrics except the free cash flow are growing at a 7 to 8% annually. But we also know what the cause for this negative free cash flow is, so it doesn't raise too many red flags, even though I don't like it. The red flag for me is raised when we combine this with the current balance sheet of the company. But before we go there, let's have a look at the profitability of the company first. And with a negative free cash flow, the free cash flow yield is also negative. The EBITDA margin, however, sits at 32.3%, which is almost double that of the sector median. The net margin also sits at slightly above 18%, which also easily beats the sector median of around 5%. The return of invested capital is a bit above 10%. So this looks all very nice. But the troubles start when we look at the net debt to EBITDA ratio of 3.5, which already sits slightly above my maximum threshold of 3 times. And when we combine this with the negative free cash flow and the investments they are currently doing, that means that the company will most likely further increase this debt level in the next years. This also means that the company is currently paying the dividend with debt. They are also issuing new shares on a regular level, and on a 5-year basis, APD has issued 0.25% new shares per year. And while this is not too bad yet, for my investments I would rather like to see the company buying back their shares. Of course, the past performance is no indication for future results, so how is the expectation for the company going forward from here? The EPS growth is forecast with an 8% increase annually until 2027, and over the same timeframe the revenue should grow with a CAGR of 6.1%. The average 1-year price target based on 22 analysts is around 10% higher than today. These analysts give the company a maximum upside of almost 40% with a downside of 18%. This is quite a large range, which shows that these analysts are far from certain. And with this uncertainty in mind, let's have a look at the valuation to see how the company is priced and if we would have the possibility to buy it at a bargain right now. The EV to EBITDA multiple sits at almost 17, which is slightly below the 5-year average, but well above the sector median of around 10. The PE value, on the other hand, is with 23 well below the 5-year average of 28 and roughly on the same level as the sector median. The price to cash flow is with 17 also lower than the 5-year average and also sits on a similar level as the rest of the sector. So overall, the company seems to be a bit cheaper than in the last 5 years, but still sits well above the sector medians. The current dividend yield confirms that the valuation is a bit cheaper than the last years and sits close to its 10-year highs. At the moment, the yield is 2.75% and the 5-year dividend growth rate is around 9.3% with a payout ratio of 60%. But again, please keep in mind that with the current negative cash flow, this dividend yield is basically funded with debt. So I would assume that the growth in the next years will be a bit slower. In the last 2 years, we already saw this growth declining from a bit over 10% compounded annual growth that the company could hold for over 20 years between 1995 and 2017. This is quite an impressive streak with a very high and stable dividend growth rate. Before we sum this up, we should also see how Air Products can stand its ground against its main competitors. For our peer comparison here, I choose Linde and Air Liquide. The total return of APD was the worst of the bunch, although, as before, most of this subpar performance came just from the last year. The company is paying the largest dividend of these three though, and also has the longest streak of dividend increase with 41 years. But in the last years, Linde could beat the dividend growth. The valuation of Air Products is in the middle between a quite low valuation of Air Liquide and the valuation of Linde that sits well above the sector average and its peers. The same is true for growth, where Linde can also outperform the peers easily, while Air Liquide and APD are battling for second and third place, depending on the metric. However, profitability-wise, our company today is quite strong, especially in EBITDA and net margin, where they are very close to Linde and both are quite a bit above the sector median. Before we sum this up, these videos with a detailed analysis of the business models and the markets take a lot of time and effort to research. So if you like the video so far, I would really appreciate it if you smash the like button and subscribe to the channel. This way you also don't miss out on my next analysis. And now let's come back to the question, is Air Products and Chemicals a good investment or not? With their industrial gas segment, the company has a very stable and predictable business, even though they are operating in a cyclical market. And even though this is a very mature market with only a few big players, APD could carve out a nice position for themselves here. Their recent focus on green hydrogen is adding a new pillar with huge growth potentials. But at the moment they are still pouring in the money to get it started, and from their financial reporting I can't even tell if it's already profitable or not. These huge investments have also put the free cash flow under pressure and it is currently negative. The debt of the company has also increased at the same time and the balance sheet is slightly more leveraged than I would like it to be. but the divestments of the LNG segment to Honeywell might bring in new money here and help to alleviate these investments. The valuation of Air Products seems very reasonable, and with the dividend yield being close to the 10-year heights, it might be worth a closer look, especially for dividend investors. I am not invested at the moment, and truth be told, I like their main competitor Linde quite a bit more. But please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.